The second thing I love about the One Big Beautiful Tax Bill are the SALT deduction increases. So if you don't know what SALT means in the tax world, it's state and local tax, SALT. If you didn't know this, you pay taxes in the state where the income is derived from. Welcome to Life Changing Money, a podcast all about one of the most taboo topics in the world, money. I'm your host, Barbara Strehand, and we're going behind the scenes on business owners' journeys to money, success, and wealth. Let's get started. Hello, and welcome to another episode of Life Changing Money. I am so excited for this week's episode because it is all about the one big, beautiful tax bill that we've all been hearing about. It was passed on July 4th, just how Trump wanted it. He had put out some arbitrary due date of July 4th of it being signed, and it was. So that was good so that the left and the right can stop fighting. But I'm here to tell you what it's all about for business owners. And let me tell you, it's really, really good. So you've probably heard about the One Big Beautiful Tax Bill, but what does it actually mean for your taxes in 2025 in this year? And what's really cool is a lot of these tax bills that are in here are retroactive to Inauguration Day, January 20th, 2025. So that's really great in terms of being able to go back and have these really cool deductions and credits on your tax return, even though this bill was not passed until July 4th of this year. So in this episode, I'm going to break down the biggest tax changes business owners need to know. There's new deductions, there's expanded eligibility for some of these deductions and credits, and then there's hidden strategies that I've found between the lines because I've read all 900 pages of this dang One Big Beautiful Tax Bill, and let me tell you, it is big. And if you want to go even deeper, I'm going to let you know now because I know this is going to sell out. Even though it's free, our Zoom seats are going to be maxed out. So you need to sign up for our free masterclass called Write Off Your Life. It's happening on September 17th, 10 a.m. Pacific, 1 p.m. Eastern, where I teach you how to write off your life, how to turn seemingly personal expenses into business expenses. And this is the last time this year that I will be hosting the Write Off Your Life masterclass. And if you've been following me for a while at Your Tax Coach on Instagram, you know that this is our signature course. I created this course 3 years ago. We make it better every single time we launch it. We launch it twice a year. So this is the second time we're launching it in 2025. And this time, well, let me back up. For those of you that already have it, which is hundreds and hundreds and hundreds of you business owners, like you're in for a treat because you have lifetime access. You get all the new videos. We are re-recording every single video that I recorded in 2022, which took a week long to record with professional videography and scripts. And it was wild and so expensive. But the feedback is you guys love my new style of creating courses. So that's how we're re-recording it. And we are doing all brand new slides, all brand new modules. And I have a surprise for you. We have a brand new Barb AI. Yes, it's literally a bot that can answer any tax question for you as if Barb was your accountant. I'm so excited for that. Okay, so let's talk a little bit about what is in the One Big Beautiful Tax Bill. So signed July 4th this year. It's basically, if you're just going to stop listening to this podcast episode now, you just need to know it brings sweeping tax changes for business owners. All of it is good, but you need to know what is new so you know how to behave. You've probably heard me say before, but the tax code is written and changed to manipulate behavior, which sounds a little gross and icky, like the government is controlling us, but they are. And when new tax laws change, it's because they want our behavior to change. They want something in the economy to change. And so they give you different incentives for different things and different industries that you have. So the first thing, qualified business income deduction. You probably don't even know that you have this, but it's been around since the Tax Cuts and Jobs Act of 2018. And what it is basically most business owners get a 20% cut off the top of their profit. And that's really what you're taxed on. So if you made 100K, you're not taxed on 100K, you're actually only taxed on 80K. That's a very simplified answer. There's a lot more that goes into that calculation, but we'll say for ease of this podcast, you get a 20% tax cut basically. And this was set to expire this year. And most business owners didn't even know that they had it. If you are our client, if you're a client of your tax coach and we prepare your tax returns, we automatically calculate this savings for you. And I swear every new client we get, we look at their past tax returns and they're like, wow, their old accountant did not maximize this deduction for them. And so you probably didn't even know that it was going to expire, but it was. And now it is back and it's made permanent, which is a huge win for business owners because literally once January 1st, 26 happened, you just got a 20% tax increase, but that isn't going to happen now. So it was also expanded to include more professionals, creators, and even gig workers. So before there were some excluded industries, and there still are some excluded industries, one of them being accountants, which I think is BS. But hey, if you're a content creator out there, a coach, a short-term rental host, a freelancer, you may now qualify for a bigger tax cut. So the second thing I love about the One Big Beautiful Tax Bill are the SALT deduction increases. So if you don't know what SALT means in the tax world, it's state and local tax, SALT. We call it SALT. There's like SALT departments at big accounting firms. I actually worked in a SALT department at PwC for a little bit, where we figure out what portion of really big companies, let's say like Apple, for example, what portion of their income is attributed to every single state. Because if you didn't know this, you pay taxes in the state where the income is derived from, where the work is done, where the work is delivered to, whether you have an employee in that state, whether you have a warehouse in that state, whether you have a salesperson in that state, whether you host an event or a retreat in that state. So probably a lot of you listening are like, wait, what? Yeah, most people do state taxes wrong. And where I think the IRS should really focus, I think the IRS should just go away. And all those agents should just work in their own state that they already live in and figure out who's evading state taxes, because it's probably most of you. So like, for example, in my accounting firm, we have clients in all 50 states. And in some states, we are over the nexus threshold. We are over the economic nexus, which means, for example, let's say in Washington, it was $100,000. That means if I have any income deriving from Washington over 100K. So if I had like 5 strategy clients in Washington, which I do, I would have to start paying Washington state tax. And so we have to file in like 30 different states because of our economic nexus. And also because we have employees in like 16 states and we have offices in 2 states. So it's a lot to manage. Also, you could cross this economic nexus, just so you know, you guys, for those of you that have courses, most course creators are doing their taxes wrong because you don't realize that you should be paying sales tax in all the different states that all of your clients are buying their courses in. So not only do you need to be paying sales tax in all of those states where they tax courses, but you could then also be above the economic threshold for state taxes in those states. So for those of you that's where all your money comes from and you're making hundreds of thousands of dollars in courses, you're probably doing it wrong. And if you ever got audited, you would owe a lot of money to all of these different states. So it's really important for you to start learning more about state taxes. But back to SALT deductions. So back in 2018, the Tax Cuts and Jobs Act, prior to that, you were able to deduct all your state taxes. So this was great for people in New York, California, Illinois that had really high state taxes. So if you were paying $50,000 in California state tax, well, good news was you could take a $50,000 deduction on your federal tax return on your itemized deductions because you're saying, I already paid $50,000 in state tax, so I get a deduction for it on my federal return. It's really to avoid being double taxed. So I think that there should be no limit on the SALT deduction. But then in 2018, the Tax Cuts and Jobs Act, as you know, whenever any bill is being passed, the left is forcing the right to do something they don't want to do, and the right is forcing the left to do something that they don't want to do. And then they kind of meet in the middle with all of these weird different tax bills. Well, one of the things that I'm sure Trump did not want to happen, but he had to cave, was saying, well, now you can't deduct all of your state tax. You can only deduct $10,000 of it. This was a huge blow to Californians and New Yorkers and Illinoisans. Like, everyone that lives in those states pays more than $10,000 of state tax. So they could no longer take that deduction. So we've been doing this for year after year after year after year until 2025. And now the SALT deduction has been increased to $20,000 if you're single and $40,000 if you're married. So before it was just $10,000, whether you're single, whether you're married, it was just $10,000. So one, that was already not fair to married people. So now they made it a little more fair to married couples. And now you can deduct $40,000, which is great. So for those of you in high tax states, you just got another $30,000 deduction on your tax returns, which could save you another $10,000, $12,000, depending on what your federal income tax bracket is. So that was another huge win for business owners in those high tax states. This one is for you real estate investors, and it's called the interest tracing with home equity. So if you take a home equity line of credit, a HELOC, you now basically have like two loans. You have your regular mortgage that you have if you have a mortgage on your house, and then you get a HELOC, so now you have this other loan. And at the end of the year, you get a mortgage interest statement and you get a HELOC statement. And before, we were only allowed to give you the mortgage interest as a deduction on your tax return because they said, well, HELOCs, you can't take the interest for because people take out HELOCs for all kinds of shit. Like, people are paying off their student loans or people are buying a car with it. But now you can legally deduct interest that would have otherwise been personal. So a lot of times people take HELOCs to fund their businesses. And now you can take that as interest, which is really great. Probably what got the most amount of tax news was the no tax on tips, no tax on overtime. And really, like, there was a lot of hullabaloo about it, but I don't think it's that sexy. Like, you get up to $25,000 in tax-free tips, which, like, if we're being honest, probably most people don't claim their cash tips anyways. Like, you know, I mean, I would have to make you claim it if I knew about it. But if we really think about it, you go to the hairstylist, you tip them in cash, they're not claiming that anyways. So this is really for the people that, like, their employer claims it. So you go out to eat, you write it on your receipt. And so it's on a credit card statement. They have to pay taxes on those tips. And so now they get to take $25,000 in tips tax-free and $12,500 in overtime. That's tax-free. But the income limits are very stringent. So you have to be like a low income worker anyway. So most of you listening to this podcast, you're probably not going to benefit from that. But I talked a lot about this one in our tax-free family masterclass, but the new standard deduction for seniors went up a lot, which was awesome because a lot of us are taking care of aging parents or grandparents. And now seniors get another $6,000 as a standard deduction. So not only did the standard deduction go up from $15,000, it was going to go back down. If you remember, prior to the Tax Cuts and Jobs Act, the standard deduction was really low, like $4,000 to $6,000. Then it was doubled and it's increased every year. So it was $15,000. Now they made those changes permanent. And they said this year it's not $15,000, it's $15,750. And on top of that, seniors get another $6,000 as a deduction or $12,000 if they're married. This one might have come as a surprise for most of us, but the electric vehicle credit is now phasing out. By the end of 2025, you're not going to get the green energy credits, the solar credits. And that was a big tax credit. It was like $7,500 for a new car. They want to manipulate behavior and change behavior from investing in EVs into investing into US manufactured stuff. And so they got rid of those electric vehicle credits. Charitable deductions also changed. So now you get $1,000 charitable deduction on your tax returns even if you don't itemize. This was really great because there's a lot of people, since the standard deduction is so high now, like $15,750 per person. So we're talking over 31 grand for couples. You'd have to have your itemized deductions be more than 31 grand to even benefit from charitable deductions at all. So let's say you were a couple and you had 30,000 of itemized deductions between your mortgage interest and your state taxes and stuff like that. You also donated to charity. You wouldn't have been able to deduct any of it. Hence, like, what's the incentive there to give money? So now they're saying whether you itemize or not, you can take $1,000 as a deduction. And then above that, you'd have to start itemizing. And they made the limit to how much you can give away higher. So before, there were some limits for your charitable deductions, whether they were personal or in a donor advised fund, whether they were 40% of your AGI, and now they can be up to 60% of your AGI. And so this is really great. And also why the theme this year at Minted Wealth Live is income and impact, because not only do we want to scale our income, but as we're scaling, we want to give back and make an impact on our communities. And so I really liked the charitable changes that we had in this new tax bill. AMT is also back. This one is like not so good, but it's also, like I mentioned, it's that teeter-totter of the left versus the right. And so sometimes we have to pass things that don't sound very good because there's other tax cuts involved and we have to balance the budget and all of that. So AMT is back, which is alternative minimum tax. Again, most of you don't know about all these different taxes that we have to pay. Besides income tax, there's sales tax, there's state tax, there's property tax, there's alternative minimum tax, there's net investment income tax, there's capital gains tax, there's use tax. There's so many different taxes. And so all of these little changes make really big differences in how much money is going to be in your bank account. So you have to know these things. And so AMT, alternative minimum tax, the exemptions are dropping and phase outs are accelerating. And so high income earners in high tax states may owe AMT again. Even if your income didn't go up, you might owe it this year. Definitely talk to your tax strategist about alternative minimum tax and if you're going to be subject to that this year. That's why strategic planning matters and you need to have a tax strategist. So don't worry if all of this made your head spin. I'm breaking it all down inside our free masterclass, September 17th, 10 a.m. PST. It's the Write Off Your Life masterclass. It's the last time I'm doing it this year. Yes, we're going to talk about the new tax bills. Yes, I'm going to show you all of the new modules that are in the course, and I'll show you how to legally keep more of your money using the exact strategies the wealthy have used for decades. And it's what I use. It's what we use for our clients, for thousands of our clients. So register now. There's a link in the bio or comment life on any of my latest posts on Instagram. You can comment life anywhere and it'll send you that free link. But remember, try to show up live because 1, the energy is a vibe. 2, you're going to get your questions answered. 3, there are chances for you to win thousands of dollars worth of prizes. And you just learn better when you have to be like on camera and be interactive. And so be there. This bill could change your tax bill and your life, but only if you know how to use it. So I'll show you how inside the Write Off Your Life masterclass. Don't miss it. Thank you for listening to this episode of Life Changing Money. Don't forget to subscribe, and I would love if you left a review and shared it with your friends. See you next time.